This lesson explains the structure of asset accounting and the key terms that you need to know before we start. Organisations often produce accounts under different accounting principles, such as local GAAP or IFRS. This can be done in S/4HANA Finance by creating additional ledgers. In asset accounting, you may have additional requirements for management accounting and tax purposes. The different figures in asset accounting are held in depreciation areas. A depreciation area corresponds to a specific reporting requirement and is mapped to an accounting principle, which in turn is mapped to a ledger. You can choose whether you want the depreciation area to post to the general ledger or not. The slide shows an example of the configuration of some depreciation areas typical of a US company that is reporting under both local GAAP and IFRS, and in two different currencies. A small UK-based company reporting only under local GAAP might only have one depreciation area, but potentially could have additional depreciation areas for cost accounting, insurance, investments, support, and so on. Every organisation will have its own requirements. Having different depreciation areas allows you to report different values for each asset, different methods of depreciation, for example straight line or declining balance, and different useful lives. This slide shows the depreciation in the Fiori app asset values, which we will see more of later in the course. The GUI transaction is AW01N, and it is usually known by the GUI name Asset Explorer. You can see the two accounting principles highlighted in red. The values on the right show the currently selected depreciation area, which in this case is the book depreciation. You can see other values by double-clicking on the depreciation area on the left. The Asset Explorer is quite a powerful tool, and we will look at it in greater detail in a later lesson. Asset classes group together similar types of tangible or intangible assets that have similar reporting requirements in the general ledger. Typical asset classes include land, buildings, plant and machinery, vehicles, computer hardware, computer software, and so on. You need at least one asset class per general ledger account, but you can have more. For example, you might want one general ledger account for motor vehicles, but two asset classes, one for cars with the default useful life of 5 years, and one for vans with the default useful life of 4 years. You can set fixed depreciation rules per asset class, or you can propose rules that can be changed where required, or you can have users manually enter the rules every time. You can also have different required fields. For example, you may want a vehicle registration number for a vehicle, but not for a building. The asset class also determines the numbering of the asset. The slide shows how asset classes can be used for reporting in the Fiori app asset balances. The transaction AR01 is the closest GUI equivalent and doesn't have charts but also shows the balances by asset class. The slide shows some examples of depreciation keys in S/4HANA. Depreciation keys work with the useful life to calculate the depreciation for each period. LINS, for example, means straight line depreciation. So if you used it with a useful life of 5 years, it would mean that exactly 1/5 of the value of the asset will be charged to the P&L as depreciation each year. This can be spread evenly throughout the year by calendar month or period, or every quarter or half year depending on the requirements. Each depreciation key breaks down further into a number of items, including period control methods, which dictate on which day depreciation starts or ends for acquisitions, transfers, retirements, revaluations, and so on. For example, some companies charge a whole month of depreciation regardless of the date of capitalisation in the month. Some charge a pro rata amount, and some only start charging depreciation from the month following capitalisation. Two special asset classes are assets under construction and low-value assets. Where assets are immediately brought into use, they can be capitalised straight away. However, if there is a delay, for example, parts are needed to construct the asset, or when building a factory or plant with labour, you can charge the cost to assets under construction, which are a kind of work-in-progress asset. Once the asset is brought into use, the costs are then transferred or settled in SAP terms to a normal asset. The asset under construction has a special key to ensure no depreciation is charged, and the low-value asset would normally have a useful life of 1 period to ensure that it's charged to the P&L straight away. Low-value assets are those that are important enough that you want to keep a register of them, but below the corporate or country limit for fixed assets. With the whole value charged as depreciation in 1 month, the effect is the same as if the cost had been expensed directly.